We're on the first learning module of the derivatives series. And this first module is a very basic introduction to this topic. So if you've had a course in derivatives before at the undergrad level, much of this is going to be very, very familiar. If you haven't been introduced to derivatives before, some of this may seem rather abstract, where you will talk about the definition of something and you may in your mind say, I'm not seeing how that works. I'll try to explain as much as I can, but all of it is explained in the modules to come, that you may leave the first module saying, I'm not sure on certain things. It will clear itself up. Trust me on that. It will clear itself up. But I will try to look forward a little bit for you in this video and try to explain something by using other things you'll see in other modules, just to give you something concrete to hold on to so it's not so abstract. So let's begin. Our learning objective, bottom of the screen: define a derivative and describe basic features of a derivative instrument. And a derivative is a financial instrument that derives, that's the key word here, it derives its value from the performance of an underlying asset. That's why it's called a derivative, because it derives its value. So let's just do a quick timeline here, and let's say that we can see some asset. We'll just give it a price S0. And we're going to have some futures price on that asset, and a future is in the future. So I'm going to agree to buy this from you, but not today. I'm going to buy it from you over here, but let's agree on a price today. And we're going to see later on that that price is a function of whatever the spot price is and continuously compounded at some interest rate for some period of time. And that will be the price. You'll see that. Don't worry about this. You don't have to make notes on this. We will see this in the future. I'm just giving you some concreteness. So we'll trade the asset, and money will trade at that period of time. Well, as time goes on, the spot price will start to do this. And the futures price will start to do that. It will mirror what's going on with the underlying. It derives its value from the performance of an underlying asset. So at any given point in time, we can tell whether the long position in a futures contract is positive or negative based on where the underlying asset is moving. The underlying can be an asset, a single asset, a group of standardized assets. So when you get to exchange-traded derivatives, and I'll give you a ticker, CL, in the U.S. market, is for oil. The underlying is West Texas Intermediate Oil, and it is for 1,000 barrels of oil, standardized. A group of standardized assets represented by one contract. Or it could be a variable, such as an interest rate. And cash flows are exchanged in the future at a price agreed on today. So we'll agree on a price today, and we will then transact at some point in the future. So more formally, a derivative is a legal agreement. It is a contract, a legal binding contract. Once we enter into this contract here, I am obligated to buy this in the future, and you are obligated to deliver it to me at that price. Even if this was $100 and we agreed that we'll trade it for $105, if at this point in time this is $150, sorry, you're only going to get $105. You have to deliver it. Simple as that. A legal agreement between counterparties, and one of these counterparties is typically a financial intermediary. Whether they be exchange traded or over the counter, we will see that on the other side of every contract is not the other party, but the financial institution that's setting it up is counterparty to all derivative contracts. Legal agreement between counterparties with a specific maturity. There is what's called the settlement date, a specific quantity of the underlying, and a specific price. When you are buying a derivative, you are considered to be long. In other words, you're going to take delivery of something in the future. When you're the seller, you're considered short. That means you will deliver something in the future. So I would buy the futures contract. You'd be selling me the contract. Since you're selling me the contract, you must deliver the underlying to me at the future. Since I'm buying the contract, I am buying that underlying from you in the future for the agreed upon price. The buyer takes delivery, the seller delivers. Derivatives can be standalone, which means you can just enter into a derivatives contract on its own without anything else going on. Hey, listen, I'll buy your car in 6 months. I'll give you $10,000 in 6 months. You agree. That's a futures contract. Well, actually, that would be called a forward contract because it's not exchange traded. There is nothing else involved, just the contract itself. I can then sell that forward contract to somebody else who wants to buy your car. You still have to deliver the car under the terms of the contract. You don't care who you deliver it to, so I'm free to transfer it as well. Derivatives can also be embedded as part of another financial product. So something you'll see at level 2 in more detail is a callable bond, where you buy a bond and there's a call option embedded in the bond. The call option doesn't trade separately, and the company has the right to call the bond away from you. So as the bond holder, you would be short the call option because you would have to deliver the bond back to the company. Now, the seller is short. So you're buying a bond and you're selling a call option at the same time. So we've said that they are contracts, agreements between two parties. They can be firm commitments or they can be contingencies. So if you and I enter into a contract and you agree to sell me something in the future and I agree to buy that thing in the future, both parties are obligated. You must sell it to me and I must buy it. I don't have the ability to say, you know what, I've changed my mind. Some derivatives are called contingencies or contingent claims, where I'm a party to a derivative, but I don't necessarily have to do something. I have the right to do something. So I'm buying a right. One person has the right, which will be the buyer. The other has the obligation, which will be the seller. So in a commitment, here's our timeline. Here's your car. I agree to buy your car at this point in time for $10K. You agree. We are both obligated. In let's say this was 6 months. In 6 months, I must buy your car for $10,000. And in 6 months, you must deliver your car to me for $6,000. However, I don't actually have to do that. What I can do is say, I'll tell you what, I'm going to buy an option from you to be able to buy your car in 6 months for $10,000, and I'll give you $200 today. So I'm going to pay you for the right to buy your car for $10,000. Now, in 6 months, if I say, hey, I want that car for $10,000, you are obligated because you were the seller. Remember, the seller delivers. I have a right. So in 6 months, I could look around and say, you know what, I can get it cheaper somewhere else. Thank you very much. And I can go buy it somewhere else for cheaper. But if I look around and I say, you know what, your car is really worth $12,000 and I have a right to buy it for $10,000, well, then I will buy it. It is contingent on the price of other cars at this point in time being higher or lower than, and we will call this the strike price of the contract. So we will see that a contingent claim is called an option. We have call options and put options, and we'll have those coming up. And commitments are things like forwards, futures, and swaps, where as soon as I enter, I am committed to doing something. Why do we want derivatives? There's a lot we can do with derivatives. It expands the market opportunities that we can take advantage of. Allow short selling, easier than you could sell the underlying asset, by the way, so we can benefit from a price decline. Now, when we're thinking about stocks, you could say, but I can short sell stocks. Sometimes you can't because they're in short supply. But what if you believed the price of oil was going to drop? How could you take advantage of that? You can't short oil. It's a physical commodity. To short oil would mean that you would have to have already had oil in inventory, and then you're going to sell the oil from your inventory only to buy it back cheaper. Can't do that, but a futures contract will allow you to short oil. Allows diversification, such as direct commodity or forex exposure. So let's say you wanted exposure to gold, GOLD. Without derivatives contracts, you would have to go to the miners and you would have to buy shares of stock of the miners. Well, when you're doing that, you're getting a whole bunch of stuff. You're getting some beta wrapped up in there, and maybe you don't want that beta. You're getting operational issues. You're getting management issues. You're getting share buyback issues, dividend issues, all wrapped up in that, but you only want exposure to gold. The only way to get it without a derivatives contract is to physically buy gold. Well, with derivatives, it allows you to be able to get access to whatever is available as an underlying. Allows for hedging of risk, whether it be financial risk or operational risk. So financial risk is you have a portfolio of assets and you think the market is going to be weak for a period of time. You can sell options on some of the underlyings that you own, or you can sell futures contracts on the index. And that will lower your beta exposure inside your portfolio. Operational issues, you are a gold miner and gold prices are elevated. And for the next 2 years, you pretty much know how much gold you're going to be able to take out of the ground, but you think the price is going to go down. So you can sell your production forward for this month. You can sell it forward as many months in the future as you want. And then all you have to do is deliver it. You mine the gold, you deliver it, you get paid. So even if the price of gold drops all the way down, you have these higher prices that you've locked in. Reduce capital requirements. So let's say that you wanted to benefit from a rise in the price of oil. The contract is CL. It is for 1,000 barrels of oil. And let's say oil is $100. That's $100K. If you wanted to have exposure to the price of oil, 1,000 barrels, you would have to put up $100,000, and then you'd have to store that oil somewhere. For a futures contract, you put up a margin. So you'd have to put up, I think on oil right now, we're about $8,000 per contract. So for $8,000, you can control $100,000 worth of oil. You profit and lose from the value of $100,000 of oil. Typically have lower transaction costs and can be more liquid than the underlying. Well, no pun intended, but the futures contract is more liquid than the oil itself when we talk about being in the physical market. So let's look at all the different types of underlyings that you can get from derivatives. Equities. Sometimes individual stocks will have futures contracts, but the biggest derivative on individual stocks are options. And not all stocks will have derivatives. Not all stocks will have options. So let's say GM. I wanted to make a bet on GM. I could just buy a call option. And it'd be cheaper than buying 100 shares of GM if I buy a call option. If the price goes up, I have the option to buy GM at whatever strike price was in the option. We'll see a lot with options in the learning modules ahead. You can buy derivatives on a group of stocks. So the OIH is an ETF called the Oil Services Index. In there you have companies like Schlumberger, Baker Hughes, a bunch of companies that are in the oil services business, not in the oil business. They're not oil producers or refiners. They service the oil companies. So rather than trying to buy derivatives on each and every individual stock, you could buy it on a group of stocks, or you can even go to the stock index. SPX would be the futures contract, the ticker for the futures contract for the S&P 500. Individual stocks, groups of stocks, and at the level of the index. So as I said on the previous screen, options are the most common at the stock level. At the index level, there are options, futures, forwards, and swaps. And just to sort of collapse these two together, a futures contract is a forward contract. They are the same thing, except a forward contract is traded through a dealer. It's called an over-the-counter derivative, whereas a futures contract is traded on an exchange and it's highly standardized. So the only difference between a future and a forward, actually I shouldn't say the only difference, the big difference between the future and the forward is that the futures is just an exchange traded forward contract that is standardized, that's all. And then we have swaps. Let's just briefly introduce swaps so that you have something concrete to hold on to. So let's think about equity swaps. We can have a pay equity receive floating or receive equity swap, or a pay or a receive equity pay floating pay equity swap. So I have a portfolio of stocks and I want to move all to cash for the next 6 months. However, this is a $100 million portfolio. I really don't want to sell all of it and then have to rebuy it all again. What I'd like to do is just stop having exposure to this, get a floating interest rate for 6 months, and then immediately pick up where I left off. Well, that's what a swap is for. I will enter into a swap with a dealer who says, I'll tell you what, You give me the return on your stocks for the next 6 months, and I will give you a floating rate of interest. So 6 months go by, and whatever return happened on this portfolio, I send it to the other side, and they give me 6 months interest. I would only do this if I think that stocks are going to be weak. So let's say this 100 million goes to 90 million. Well, I give them negative 10 million. Well, giving them 10 million means they owe me 10 million on top of the interest rate as well. So I can reduce my exposure to equity really quickly. Let's say that instead of having the portfolio, I have 100 million cash and it's invested in short-term T-bills. I'm getting a 3-month rate on it. But for the next year, I'd like to get an equity return, but I don't really want to go out and build a portfolio of equities. I'd like to get exposure to the S&P 500 without actually having to buy anything. Well, there's the equity swap. What I'll do is I'll receive the equity return and I will pay the floating rate and maybe some spread because I probably am a credit risk. So I would pay the dealer whatever the floating rate is plus some spread, and over the next year, whatever the return on the equity market is, the dealer would pay me the return on the equity market, and I never, ever have to move my 100 million out of treasuries. So swaps are really powerful for getting access to or reducing exposure to a particular underlying for a period of time. Allows an investor to get or remove exposure without buying or selling or having the risk of taking delivery or delivering. So I have 100 million, just to clarify this, and I want exposure to the equity market. I can buy a 1-year futures contract on the equity market, but I'm obligated because I'm part of a futures contract. I don't want the risk of taking delivery or delivering. So I'm going to avoid options, and maybe I'm going to avoid forward contracts and futures. The swap allows me to get it done without any obligation to make or take delivery. We're simply just exchanging cash flows, not the underlying. Derivatives are also available on the realized volatility of equities. So I can make a bet not on the return to equities, but on the volatility of equities. So let's say that I'm observing the market and the market is really, really calm. So the market's doing this and it's got very low movements per day, very, very small movements per day. So if I measure the standard deviation, instead of getting something that looks like this, for a period of time, I'm getting a very, very low standard deviation on the equity market, and I think, well, that can't hold. The volatility of the market is going to increase back to its historical levels. I can go long volatility. There are contracts that I can bet on the shape of the distribution of returns, not on the returns themselves, but on the shape of the distribution. So I can manage the dispersion of the returns separately from the price direction. And this is very common to do after a big market sell-off. Volatility is very, very high. So if we look at the distribution of returns on the market, it looks like this. It's got a very wide distribution, and we know historically it looks like this. So we say, well, volatility is going to shrink. So I could buy the equity market on the bet that it's going to rebound, or I can just sell a contract on the volatility of the index to say that it's going to shrink. If I buy the market and think it's going to rebound, I make money if it goes up. However, what if it stays here and then just calms down and goes sideways? Well, I don't make anything, but the volatility will drop. So you can make a bet on the dispersion separately from the returns. Isn't that exciting that you can actually get exposure to that? All right, fixed income. Let me just take some of this stuff out of the way here. This is a neat little program I got. I can erase anything that I put in place to bring our attention back to what we're doing. Fixed income. Underlying can be bonds. We'll see that it also could be an interest rate, but the underlying can be the bond. There are options, futures, forwards, and swaps. So some examples of futures contracts. I'm giving you some tickers here. ZN and ZT. N for the 10, T-E-N, T for the 2, T-W-O, ZN and ZT. This is the 10-year U.S. Treasury. It's for $100,000 of a generic underlying bond. The bond doesn't exist. It's a generic 6% coupon bond. The 2-year is for $200,000. It's a bigger contract. And the underlying is a generic 6% under bond. And since there is no 6% $100,000 bond, there will be bonds that when combined with a conversion factor will be equivalent to a 6% $100,000 bond. That is called a cheapest to deliver. So the 10-year futures contract will be associated with some cheapest to deliver actual bond that with a conversion factor will be equivalent to a $100,000 6% bond. A little bit of a look ahead here. If it seems a little confusing saying, can you explain that more? Don't worry, it will be explained more in modules to come. I'm just sort of giving you just a little look ahead here. Next, for fixed income, we can have, rather than a bond being the underlying, we could just have an interest rate as the underlying. And you can have options, futures, forwards, and swaps on interest rates. Swaps by far being the biggest part of that market. When we talk about the underlying being an interest rate, we just shorten it to MRR. It'll refer to some reference rate, some market-derived reference rate. For the longest time, LIBOR was the biggest market reference rate, but LIBOR has gone because it's not market determined, it's interbank determined by just a survey feature, which means it's open to manipulation, and it was an unsecured rate. And being that it was an unsecured rate, when you get to level 3 and we introduced something called the cross-currency basis swap, you had other market reference rates in other countries that were secured rates, while LIBOR was an unsecured rate. So setting up these cross-currency basis swaps always required some analysis of the credit risk involved. Well, now that's gone. LIBOR has been replaced with SOFR, the secured, notice now it's secured, overnight funding rate. And it is secured by U.S. Treasuries. So it will be a lower rate than what LIBOR would be because LIBOR was an interbank lending rate that was unsecured. So let's see how swaps work. And swaps, all we're doing is trading cash flows based on an interest rate. We don't actually exchange the underlying value of whatever the interest rate is on. So no money changes hands. Only let's say we have a timeline, a 2-year swap, and we're going to have 6-month payments. So in 6 months, we have a fixed rate, RFX, and we have a floating rate, RFL, and we have a notional amount. So we'll enter a contract and we'll say, let's exchange cash flows on, let's say, $10 million. So at this point in time, there's a fixed rate on $10 million that you pay the other side. And at this point in time, whatever the floating rate is, we observe the floating rate here, and it's paid at the end of the period. You pay it this way. And whatever this floating rate is here will be the payment made here to the other side. And that is a fixed rate paid to this side. And they're just swapping rates. So they're referred to as a pay floating received fixed swap or a pay fixed receive floating swap. For the pay floating receive fixed, you're going to convert a fixed rate to a floating rate, and this way here is the opposite. Let me explain that. I have a loan. It has a fixed rate. I'm just going to write FX in there for fixed rate. And I think interest rates are going to drop over a period of time, and I have this loan here, and let's say I'm paying a 5% rate of interest on it, and I think interest rates are going to drop. I would rather have a floating rate, a floating rate on this one. I'd rather pay a floating rate, so I know I want a swap in which I pay the floating rate. And I want to receive the fixed rate, because when I receive the fixed rate, I have a loan, I pay the fixed rate, and I pay the floating. I've converted my fixed rate loan to a floating rate loan because the fixed rate I receive offsets the fixed rate I pay, and then I pay the other side the floating rate. So I can convert my fixed rate loan to a floating rate loan if I think rates are going down. I can do the opposite if I think they're going up. So if you are an investor in MREITs, these are mortgage REITs. Mortgage REITs will sometimes just take what they get. Those are the nicest ones because then you can determine whether you want to be in a mortgage REIT or not based on your view of interest rates. And sometimes mortgage REITs use swaps to convert the type of cash flows they have, and then you're relying on them to make an assessment of where interest rates are going to go. And if they get it wrong, well, then you suffer. So these types of REITs that use a lot of swaps aren't valued as well as the mortgage REITs that don't use swaps, because the investor can then determine whether they want to be in or out. It gives more power to the investor. The other thing that swaps can do with a portfolio of fixed income is it can increase the duration of the portfolio or reduce. So let's say I have a $100 million bond portfolio, and I think interest rates are going up. Well, if interest rates go up, what do we know happens to the price of bonds? The price of bonds go down. I'm going to lose capital value, but I'm not going to lose anything if I hold them to maturity, right? But still, when I marked at the end of the year, when I mark all the bonds to market and I report my returns, I'm going to have negative returns. Well, what I'd like to do is reduce the duration of this portfolio, because duration is my sensitivity to interest rates. So imagine you could have a portfolio of bonds with a duration, let's say, of 6, and you could do something to get your duration to 0 without selling any bonds. Well, that's what a pay fixed, receive floating swap will do. It reduces duration. Because this is equivalent to being, if you're paying fixed, it's equivalent to being short a fixed rate bond and long a floating rate bond. Well, the fixed rate bond will have positive duration, very high duration. The floating rate bond will have positive duration but very low duration. Well, you're short something with long duration and you're long something with short duration, so this will have negative duration altogether. You can lower the duration of the portfolio. That's a look ahead, and that's a look ahead all the way to level 3 as well, that you can use swaps to not only convert the type of interest rate you get, a fixed rate to a floating rate, but you can use swaps to increase or decrease the duration of a bond portfolio. Currencies. You can take a directional view of a currency or hedge a currency exposure. Let me remove this out of the way so we can concentrate on what we're doing. And commodities, you could do the same thing. You can take a directional view on commodities or hedge a commodity exposure. Brokers do not allow delivery if the underlying is physical, and even for contracts like ZN and ZT. The 2-year contract. Remember, we looked at it on the other screen. It was a $200,000 6% generic bond. Some brokers will not allow delivery of that underlying, so the contract has to be closed before the delivery period begins. Next, we have credit. The big one there is the CDS, the credit default swap. And it works a little bit differently than most derivatives because of the way that long and short works. If you're long a CDS, you're actually short the credit quality of the company. So let's say a company ABC has a bond, and you think ABC isn't doing very well, and the credit spread is going to widen. Widen meaning there's more, the market will see more and more credit risk, and that credit spread will widen. Well, what you want to do is you want to be long the credit spread. You want to be long the credit spread because you benefit if the spread increases. Well, when you're long the credit spread, you are inherently short the credit quality because you think the credit quality of the company is deteriorating. That can be confusing sometimes. When you're long the CDS, you're betting that things are going to get bad for the company and the credit spread will widen. If you're short the CDS, you're actually long the credit quality. You're bullish on the credit quality of the company because you're short the spread, you'll benefit if the spread decreases. So the long CDS, short CDS is long the spread or short the spread. Being long a spread is not a bullish thing for a company. That's very bearish because you're short the credit quality. That can be confusing. So I thought better see it now, because when you see it at level 2 and at level 3, it causes a lot of confusion. Other types of derivatives. You can bet on weather. You can bet on cryptocurrencies. There's a whole bunch of stuff you can bet on. So this is from the reading itself. This is just a good summary of everything we've done. We've looked at equities, interest rates, foreign exchange, commodities, credit, other. There's weather, cryptocurrencies, individual stocks. So we can change exposure profile, and for options, They're also used for employee compensation. I'm not going to go through each of these. I already have. It's just a nice summary of all of the underlyings. Here's some of the examples given and some sample uses. Next learning objective, we can get it done all on one screen too. Describe the basic features of derivative markets and contrast over-the-counter and exchange-traded derivative markets. So let's start with over-the-counter, shortened to OTC. This is a dealer market, and dealers are called market makers. So if you wanted to enter into a swap, you contact a dealer. You don't actually have to find somebody else that wants to swap interest payments with you. You simply have to contact a dealer. The dealer will be on the other side of the contract. That's why on the first screen, we said the counterparty is typically a financial institution. So you call the dealer desk and you say, I want to enter into a swap. They quote you the fixed rate of the swap and you either say yes or no. So it's a dealer. There's no centralized exchange where you could just buy and sell them on your own. But because it's a dealer market, the terms can be customized. Once we get to exchange-traded derivatives, they are very standardized. You don't like, you don't want to have 1,000 barrels of oil as the underlying. Well, that's too bad. That's what the futures contract is. You can't say, can I make it 1,500? Nope. So OTC can be customized, less transparency, and no daily settlement. When we say less transparency, is the trades don't have to be reported anywhere. On an exchange, every time a contract is traded, it's reported in the sense that there was volume, there's open interest, so you know exactly how much activity is going on. But within the OTC market, you don't know. You don't know at all. You'll come across this statement that the OTC market is less liquid, though that is not quite true. If I want to contact a dealer to enter into a swap, if I agree at the fixed rate, I'm in. If I want to get out of the swap, all I do is I contact the dealer and I figure out, well, what offsetting swap would negate the first one? And if I agree on the rate, it's done. So it's liquid because the dealer is ready to enter into a swap at any time if you can agree on the price. So it is liquid in that sense that it's not as if once I enter a contract, good luck getting out. You can get out. You can always get out. Same with exchange-traded derivatives. There's more liquidity there in the sense that you can easily trade them on the spot. There's a quoted bid and ask. But if you call a dealer desk, you can get the same thing. So it's not quite true that they're less liquid. Exchange-traded, these are standardized. While OTC can be customized, these are standardized. They are liquid, but not always. And this is the thing that frustrates me whenever I see textbooks saying OTC contracts are less liquid and exchange traded are more liquid. They're not always. You can have options on a particular stock and the options can be absolutely illiquid. Big spreads between the bid and the ask, which means you're not getting in. And even on a liquid underlying, let's take the SPY, which is an ETF that tracks the S&P 500. And let's put a timeline and let's say that it is March. Well, you can go all the way out to January of the next year and even January of the year after. These are called LEAPs, long-term equity anticipation securities. Well, if you go all the way out to here, the bid and the ask spread is so wide and there's no volume going on, they're illiquid. So yeah, they're liquid, but not always. The front months are very liquid. Now you can look at some stocks, and DuPont is a good example of a stock that has options, and the front month is just not liquid. The big bid and ask spreads, bid and ask for the options, it's expensive to get in, it's expensive to get out. There's not a lot of volume in there. They're not liquid at all. So we say they're liquid, but not always. We say these are less liquid, though it's not quite true. So just understand that. Transparency in the sense that if you do trade, it's traded on an exchange. That transaction counts as volume. Other people can see that a transaction has taken place. Although they don't know it's you, they don't know your name, they know a transaction's taken place. There is a central clearinghouse for exchange-traded options. The clearinghouse is counterparty to all contracts. So if I buy oil CL and I buy it on the futures market, I am long CL. Here is the central clearinghouse, and here is whoever has happened to be on the other side, whoever the seller happened to be, and here is the buyer, here is the seller. I'm not contracted with the seller. I am contracted with the clearinghouse. The seller is contracted with the clearinghouse. We both post margin to the clearinghouse, and the clearinghouse guarantees the performance of the contract on both sides. So I have no counterparty risk because there's a clearinghouse. Margin deposit is required, and all gains and losses are settled every day. So even if it's a 6-month contract, we don't wait 6 months to change cash flows. If at the end of the first day I happen to be in gains, I get my money. We're going to see how this works in the modules ahead. There is something called central clearing, and this is a recent addition for some OTC contracts because the clearinghouse is specifically an exchange traded thing. There's always a clearinghouse if it's exchange traded. Not so much if it's over the counter, but more and more so, central clearing is being required only because there's so much risk, systemic risk that could exist in the OTC market. There has to be some way to control that risk. So swaps are a good example of a derivative that is becoming more standardized in terms of requiring that they be reported to a central clearing firm. So the central clearing will take care of the management of credit risk, so it reduces counterparty risk. It takes care of clearing and settlement. So the old model was party one and party two were party to a swap, with one of them being a financial institution. Now party one and party two are counterparty to a swap with the central clearing authority. So here's our swap. It's at the central clearing. Party one is in a contract with the clearing firm, and party two is in a contract with the clearing firm, as opposed to being with each other. With each other here, they, party one had to trust party two, and party two had to trust party one. Now, one of them is a financial institution, one of them is not. Well, what if this person couldn't pay? Not only that, what if the financial institution was in a whole bunch of these swaps as counterparty and things went bad and this guy failed? Well, then nobody gets paid. There we go.